Hello viewers, hello accounting professionals. Welcome. Today I am explaining you the difference between IFRS and US GAAP recording the inventory. There are a lot of changes between IFRS and US GAAPs. In that, today we are discussing inventories. IFRS accounting for inventories differs from US GAAP in three areas: cash flow assumption, valuation of inventory at year-end, and capitalization of interest. I am telling you again: cash flow assumption, valuation of inventory at year-end, and capitalization of interest. We'll discuss each point in our next slides. Cash flow assumption. Earlier, under US GAAP, LIFO is permissible, but now, according to IFRS, LIFO is not permissible. FIFO and weighted average methods are acceptable methods. Retail method may also be used for certain industries, and gross profit method can be used to estimate ending inventory when physical count is not possible. That is cash flow assumption. So we discussed cash flow assumption, and the next point, valuation of inventory, how it differs from IFRS, US GAAP to IFRS. So valuation. Earlier under US GAAP, inventory value, cost or market value, whichever is lower. But now, according to US GAAP, cost or net realizable value, whichever is lower. For this, there is one exception. Agricultural inventories are carried at fair value less costs to sell at the point of harvest. And here we know about cost. Cost means purchase price plus direct cost related to that inventory. And what is net realizable value? Net realizable value means estimated selling price minus estimated costs to complete and sell. That is, so how do we value inventories under IFRS? Cost or NRV, whichever is lower. And next, capitalization of interest, that thing. So previously under US GAAP under US GAAP we don't capitalize interest, but under US GAAP we have to capitalize under certain circumstances. Here is the point. US GAAP allows no capitalization for inventories that are routinely manufactured. However, IFRS allows inventory costs to be capitalized if there is lengthy production period to prepare the goods for sale. So, if there is lengthy production period to prepare the goods for sale, then under IFRS we have to capitalize the interest cost. Okay, and here is one more slide. Under US GAAP, once inventory is written down, a loss may not be recovered. Once inventory is written down, a loss may not be recovered. Under IFRS, previously recognized impairment losses are recovered. We can recover whatever we write off in the previous years. Under IFRS, costs included in the cost of inventories. That is abnormal waste, storage cost, administrative overheads, and selling costs. These are not going to include in the costs of inventory. Okay, and next, and the summaries: cost. LIFO is not allowed, and FIFO is allowed, and weighted average method is allowed. And measurement, how we will measure cost or NRV, whichever is lower. What is net realizable value? Net amount expected to realize from selling inventories during ordinary course of business. Net realizable value is entity specific. Cost of inventory means cost of purchase, cost of conversion plus other costs. Cost is not included in the cost of inventory, abnormal waste, storage cost, administrative overheads and selling costs. Thank you. We will meet in the next session. Thank you.